Hey everybody, this is DayTraderRockStar. In today's video, we're going to be talking about how important reversal candles are in your ES trading strategy. Now, if you listen to the show, hopefully you do, daytradingradio.com on every single day from 8 o'clock until 4 o'clock, and then we're bringing back the overnight shows too, so keep an eye out for that. Also get on the mailing list. Better yet, become a member of Day Trading Radio, and then you won't miss anything. But let's just jump into this video today. This is actually today's ES mini chart. We traded this today. We focus on this as our underlying index. We follow the S&P, but we follow the futures because we trade stocks, futures, options, and and this is our go-to vehicle for trading futures, the ES mini futures. December contract. Now, the blue circles you see here, these are strategies, the member strategies that we use trading on the high probability setups. And we try to take our positions based off of these. And today, we had a great day of trading. But one thing that really came out to my attention is the importance of the candlesticks. All of the setups that I typically get into have to require multiple scenarios happening, multiple indicators lining up. The indicators are not a secret, I look for a recognizable pattern. I look for that what we call 1, 2, 3 patterns. We use the oscillator, stochastic oscillator, but I use different time frames of this. And we have one special one we call ram in the bush, which we look for a divergence in that one. That one's kind of exclusive to members. And when these things line up, we pretty much want to take that trade. That is what we come to work for, and it's important to kind of gather all those indicators, tie them all together, and have that capping candlestick. The candlestick now is what we're going to get into is so important. It's really on the most basic terms, the candlestick here kind of measures out, bringing this over, just basically what's happening during that time frame. And on a more of a basic level of this, a candlestick could go from the 1 minute, 2 minute, whatever you want to define it. That's the time frame. And I follow on the show the 1 minute, but we also refer back to the 5 minute, the 60, the daily. So any of these, right now we look at the 1 minute candle, and we look for these divergences that happen on the 1 minute candle, where we have some of our indicators diverging each other. And those are our signals. But along with that, it's really important to have that reversal candle. And the reversal candle, and that's what I want to just make the focus of this video today, is really based off of identifying a short-term trend. And when we look for a pivot area or a reversal, we want to see, there was a trend up here. There's a slight upward trend. We don't want to just get a reversal candle in chop or sideways action, but we want to be able to establish that reversal that really takes out the highs of the previous, trend, or at least a higher high or a higher low. A lower low, depending on which trend you're looking at. But that's what we want to see. When we see a change of trend and we want to see a nice trade, we want to see that candle take out the recent highs, close back down at the lows in the case of a sell signal. So we're actually moving a little bit higher, and then sellers come in before the candle expires. This is a 1 minute candle. Over here in the upper right hand corner, you'll see a candlestick counter. And that counter basically tells me how that candle is setting up before it actually sets up. So I'll be able to say, well, it looks like a reversal here. We got all the criteria. We could take our position, and from that point on, we get our trade. Another strategy we have is called the triple stochastic reversal. And here we have the 3 bands of the stochastics I pay attention to and look for that reversal candle. In that case, we took that trade today, and you can see that. And that candle, again, is really, on its own, works great. So combined with our other indicators, it's really the cherry on the top of the cake there. It is a perfect setup, and what makes it so great is you use that candle. Typically, that candle will mark that bottom or mark that top. We use that candle as our stop. That's our defined stop. That is our robotic mind, not guessing where we're going to put the stop. But if this pattern is going to play out, and this methodology is going to play out, everything is in place. It should play out. We shouldn't adjust it any more than to this candle. So this candle automatically gets put in as a stop. We adjust our stop right when we place the trade, and we can let that roll. Now we have exit strategies also. That can play out in candles, but we use other things, and we're not going to talk about that. But like I said, we talk about that during the day, during the show, and as members, we have videos on that. But as we go on through the day, as you can see here, that was one of a nice setup. Here we had kind of a bullish setup. We noticed this bullish setup. We had a trend line retracement, not much going on, but we had this another nice little blue line. The blue circles are our best setups of the day, and we identify these live real time. So when we see this is what's important to understand why we're seeing it, what happens. But you can see here the topping, the cherry here is that candlestick. We have the divergence. We have some other things happening. We have the rotation, but that's the candle we want to see. The candle takes out the recent high, closes on in the lows. That's a reversal, and then from that point on, we moved up lower. In this case, we moved much lower. Here we had that same scenario. We had our actually, there was a nice little flag set up here. This was a 1-2 combination. Typically, when you see that divergence play out, you have a little dip, you have a little push, and then you have a flush down, and that flush gives us that candle. That candle is typical of what happens in a lane divergence. So that's why we want to always look for that candle. But in this case, right before we had that lane divergence, we were able to tell that we had a good shot that was going to happen, because this is one of our strategy flag setups. It's the bear flag, where we have an embedded medium, an embedded slow, and a fast rotation of the fast. That gives us that setup to the downside. All right, so again, we have a great setup here. It was actually a double bottom reversal candle strategy setup, and of course, what we're talking about is the reversal candle. That is the key. That is the key of this video. It's the important part of this video. We use the reversal candle on a lot of the strategies here. Just what we want to see there. It defines our stop. Most of these setups, when you have those reversals, we don't even test. We don't even get tested. We don't get any pressure against the trade. That means we don't actually push back down here. We did eventually down here, but most likely, you get in that reversal, you're able to identify it with your candlestick counter, and you're sitting pretty on your trade. You just have to have your exit strategy. Remember, these are short-term strategies. So really, as we set them up, we should knock them down on the opposite signals. So for us to get into this, we have to have certain things line up. Maybe definitely we want to have the wind in our sail with the stochastics turning back up. In this case, there was a beautiful divergence here. But this is really active until we get overbought. So as you get up to this level, we want to start to identify that profit. We get right up here, and we start to get overbought, and we want to take that profit. We don't want to stick around and hope that this is going to break out. All right, we want to take it off, wait for the next setup, the next reversal candle, and then we're going to trade that. So the divergences were coming out great. As long as you understand how fast those rotations happen, and understand you're trading the 1 minute time frame versus the 5 minute. The 5 minute, we go to the 5 minute chart. You could do the same thing using the 5 minute candles. I'm just giving an example on the 1 minute candles, but you could actually see sometimes the 1 minute and the 5 minute line up together. So we actually, because of the HPS methodology, we use multiple time frames, and it's usually, for us to get that signal on the tradeometer or to get the signal, it's usually have to have that 5 minute on our side. So if we could look back, we're probably going to have a beautiful 5 minute candle. Here's a great 5 minute candle right there. Here was a great 5 minute candle right there. There was one. Here there was not really one, but we did have that divergence. And here we had a big candle breakdown, but it wasn't that reversal that we normally look for. But there was a couple 5 minute reversals here. And again, same thing as we look at stocks. We want to, sometimes identify. We're not going to look at stocks too much today, but I just want to, point out. Here's your 5 minute cash setup. Let me see if I could. I'm not going to. I didn't prepare any stocks. This was basically just to talk about those candles and how important they are on the 1 minute time frame. But again, they work just as well on the 5 minute time frame. They're the key to ties everything together, and I use them for my exit strategies. Great candles. Let's talk about what candles we want to use for a reversal candle. All right, let's just finish off with the video with what kind of candles we want to use as a reversal candle. Let me get to that right now. All right, these are just a few of the candles you'll see that I pay attention to. Bullish engulfing or bearish engulfing. Basically, we could also consider that an outside day. Outside day is another way of looking at the, well, I want to show you examples of that. Hammers, piercing patterns, Morningstars, opposites, the hammers, and tweezer patterns, which I don't talk about too much, but we see those every so often. I think I have a couple of examples for you. So this is a fast run through of the bullish engulfing pattern, and I'll try to show you an example on the chart also live. I did see a few of these setting up. Again, a simple engulfing pattern. Basically, it's what it sounds like. The pattern here, or at least the body of the candle, engulfs the previous day's body. And a bearish engulfing would start off higher, close lower. The bullish engulfing, open of the day 2, it goes back up, and it closes on the highs and engulfing the previous day's body in itself. And that's typically a very bullish setup. Now, an outside day would really, this counts as an outside day because the lower wick of the candle engulfs the low of the day, and the top of the candle up here is higher than the top of the candle previous day. So that's an outside day versus an engulfing pattern. Outside days, I think, are really, really great because they take out the lows of the session and you close near the highs of the session. Here's an example over here. Basically, you come down, you start off lower, but you end higher. And lots of times you'll find those in those patterns. This could have even been a divergence setup, but typically you find them in these patterns, and that's what you have to look for. Same old, same old. Just waiting for it to show up. Let's see what the next one is. Hammers. Hammers are very simple. A large, large tail. Again, you want to look for this hammer at the end of a pattern. How do you know it's the end of the pattern? Well, you at least have to have an established trend going down, for a while. So, over time you'll experience that. And once you start to get oversold using your oscillators, once you start to see maybe other support lines come up, even using volume profile, you're looking for the capping, that little trigger, and the trigger would be the candle, an engulfing pattern, a hammer pattern, something that takes out the lows, close on the highs. The body gives us that hammer appearance, where you have that long handle, that tail, that gives that hammer appearance. And from that point on, again, same reversal. Once you get that, you trigger into your trade. You use the lower portion of this shadow, 1 tick, 2 ticks underneath it as your stop. Piercing pattern. Basically the same concept, except we're taking out the lows. We push back up over 50% of the previous day's body. So you want to at least pierce back into the previous candle. And that's basically it. Basically, the object here is to take out the lows and reverse and close near the highs. The better, I think the better it is that we take out the lows of the previous lows, but we take out that trend low. It should be at the end of a trend, and we reverse into that. Now, here's a Morningstar. I don't pay attention to this that often. You gap down, you gap up. You might even want, there's also we call island reversals, where you have a gap leading to a price or leading to the candle, and then a gap back up, and it leaves this little island back down here. We don't see them that often. I don't really look for them too much. I have them down on this webinar I did. But the tweezer bottoms, that's an interesting one. Two candles that basically are identical in nature. They should have very similar wicks, come down, usually have the same type of support, almost a double bottom. So basically picture maybe two hammers, and here's, I want to move this back over here. And today we actually had some interesting candles. We had some really big candles, and we almost can consider this kind of a tweezer type of candle after a candle. I kind of don't look for that exact double top as a tweezer, but I look for two candles that represent a push higher and a reversal lower, and then we push higher and reversal lower next to each other. Kind of that tweezer look to it. And from that point going down, we did have a few of those actually play out, and that was a good example right here. You maybe even look at, but typically they happen within a couple candles of each other. All right. Let me see. We bullish engulfing pattern. Let's go back for another example of that. And basically, you can see the engulfing pattern engulfs the previous day pattern. There it is. There it is. Just giving you some other examples. Hammers, lower channel. The hammer takes out the lows, close on the highs. Doesn't have to close exactly on the highs. It has to have the appearance of the hammer. All right, and then look at the hammer. Lots of times we'll get those hammers and marking areas of resistance or support, and that's what we just looked at before. Piercing pattern, great example. Big candlestick took out the lows, pierced back into the other candle, follow through day. These are so important. Just very basic. You don't have to look at every. You don't have to have Neeson's candlestick book and learn about every single candlestick combination. Your head will explode. This is what you have to pay attention to. The couple that we just talked about today. All right? That added to the high probability methodology is unstoppable. Today we did great. Tomorrow we're going to do great. I invite you to come by the station if you're not used to. If you haven't watched it, DayTradingRadio.com. We go on the air at 8 o'clock. We go on the air. We're on the air right now, actually. We're on the air overnight 24/7 for the futures especially. But we'll be broadcasting live from 8 o'clock on from tomorrow morning until the close. So have a great evening. I will talk to you next video.